What's going on, everybody? It's Ryan from Mortgage Bro Science, and in a video I just uploaded, it is June 4th, 2026, I went over conservatively qualifying for a loan. All right, now some people are going to be saying, oh, 35% back ratio, who's doing that now? And, there's a little bit of ambiguity here, right? Everyone's scenario is a little different. Maybe you're just going on the note, but you have a fiance or a wife that's not there because her credit's bad, or you just want to buy a house yourself. Or maybe you have another type of income, like maybe you're a bartender that makes cash and you can afford a little more, and you're willing to go up to, say, a 45% just because you actually could take care of yourself. Okay, maybe your job's really secure, or maybe you just want to take on the risk and be sweating it. At the end of every month, you're not saving as much. Either way, you can do whatever you want. If you really like a house, go for it. Okay. So what I want to do is I want to take the same concepts as the previous video. All right, I'm not gonna lie, I don't remember what I said for student loans and car payment, but I'll try my best. All right, so same rules apply here. Okay, HB12C. There is a link in my bio to download this yourself. I highly recommend doing it because math is actually pretty fun when you understand it, right? Like most things, once you understand stuff, you're good. Oh, look at that, Firestone. You guys need new tires? Go to Firestone. That's one of those unforeseen costs. That's why you shouldn't max out what you qualify for, right? So, take 100, all right? Divide that by 12. Your gross monthly pay is $8,333.333, all right? Now, this is going to sting. Imagine you use 45% of this income to pay for all your debt. That's what some people do. Some people even go higher, which is absolutely bananas. All right, FHA loans, you can go to 57, which I don't know why the government allows that, but the government is the government, right? So anyway, from there, you click enter and 0.45. Now, I want to be very clear on this. That's 45% of your income is going towards debt. All right, it's diabolical. I don't recommend doing it, but I see the need for people to do so. Some scenarios, it actually makes sense. Some scenarios, it does not make sense. All right, but that's up for you to decide. So 45% of 8,333, that's a $100,000 salary, is $3,750 a month. All right, from there, take out student loans, assuming you have student loans. If you don't have student loans, good on you. Less 300, okay? And then you have a car payment. Oh, this math actually works out nicely. I think I said $450. Your car payment, your lease is $450. All right, $450 less. That leaves you with $3,000 to pay for principal, interest, taxes, and insurance. This is assuming no PMI. PMI you have to pay when you put less than 20% down on a home, unless you have a special CRA or first-time home buyer product that does not require PMI. Okay. All right. Let's assume homeowners insurance about $150. And then taxes, let's just use that number again at $500 for monthly taxes. This means your annual taxes are $6,000. All right, $6,000 divided by 12, you're looking at $500 a month, and this will go towards escrow. All right, now that leaves you with $2,350 to pay for just principal and interest. And to be honest, this is a pretty good number. Like, you guys are gonna like this number a lot more than the other number I gave in the video I uploaded, 5 minutes ago. But you'll see where I'm going with this. All right, so then you click PMT. All right, this is your payment, just principal and interest. We're going to use 6.25. I said 125 last time. Just ignore me, follow this. 6.25, a good 30-year fix right now is about 6.25. You could probably find a little lower, but 6.25, okay? GI, okay, remember, because 12 months in a year. And then 30-year fixed, 30 GN, all right? And then you click PV for present value. This will be your principal balance, the mortgage you're taking out. So this, at a 45% versus, and all the variables held true, versus a 35% back ratio, brings your mortgage from, what I say, it was like $250 or so, to about $380. Okay? And then, from there, you click CHS, because you want to be positive. All right? You take 380, it's 381,668. 0.8 divided by, now that is now a purchase price of $477. All right, so it definitely gets you more home, in a home that's not a beater, and a home that you don't need to put a lot of money into. All right, there's a lot of people that are like, oh yeah, home needs a lot of work, and in my mind I'm thinking like, they don't realize how much time and money goes into fixing up this house. Sometimes it's worth it, just buy a house with a finished bathroom that's renovated, right? But again, everyone's different, so you decide. But this is how you would qualify what you should max yourself out on. Now, once again, I want to be super clear, right? If you are using 45% of your income to go towards debt, all right, now you might pay your car off in the future, and the student loans aren't going to be there forever. Like, what if you need a new car? What if you need new Firestone tires, right? Shout out Firestone. Okay. If you got to finance anything else, now all your debt, you're creeping up to that 50% of your income, right? You got to remember utilities. You got to remember groceries. You got to remember the emergency fund. If you got dogs, I love them to death, but dogs get expensive. So I really like to see everyone be around a 30 to a 35 DTI. I know it's hard, but anyway, this is the math. This is how you pre-approve yourself. This is exactly what banks are going to do. Just be conservative with it. And remember, share this video to anyone who might find it useful. And of course, like and subscribe. Any questions at all, drop a comment. Say something funny. All right?